$1 trillion is a lot of money. If you stacked $1 billion bills on top of one another, the pile would be 67.9 miles high. But if you stacked $1 trillion bills on top of one another, the pile will be 67,866 miles high. And if you lined up $1 trillion bills end to end, the line of dollar bills would be a staggering 96,906,656 miles long. That is longer than the distance from the Earth to the Sun. $1 trillion is such a vast amount of money, it's truly difficult to comprehend. But as you will learn today, that much money has already been pulled out of vulnerable U.S. banks over the past year. Hordes of small and mid-sized banks are now in trouble. And that is really bad news because those institutions issue most of the mortgages, auto loans, and credit cards that our economy runs on. The other day, I asked my viewers to imagine what our country will look like if the banking system implodes and the economy plunges into a depression. Because if our banks continue to collapse, that is precisely where we are headed. Unfortunately, the recent banking panic has greatly accelerated matters. In fact, a whopping $98.4 billion was pulled out of U.S. banks during the week ending March 15th. The readout, released shortly after the market closed Friday, came around the same time as new Fed data showed that bank customers collectively pulled $98.4 billion from accounts for the week ended March 15th. That would have covered the period when the sudden failures of Silicon Valley Bank and Signature Bank rocked the industry. Just think about that, eh? Nearly $100 billion in deposits evaporated in just 1 week. And it turns out that small banks were being hit the hardest. Unsurprisingly, big banks actually saw enormous inflows. Data show that the bulk of the money came from small banks. Large institutions saw deposits increase by $67 billion, while smaller banks saw outflows of $120 billion. The withdrawals brought total deposits down to just over $17.5 trillion and represented about 0.6% of the total. Deposits have been on a steady decline over the past year or so, falling $582.4 billion since February 2022, according to seasonally adjusted Fed data released Friday. Earlier this week, Powell also sought to assure the public that the banking system is safe. He said, "You've seen that we have the tools to protect depositors when there's a threat of serious harm to the economy or to the financial system, and we're prepared to use those tools," Powell said Wednesday during a news conference that followed the Fed's decision to hike benchmark interest rates another 0.25 percentage point. "And I think depositors should assume that their deposits are safe." Powell noted that deposit flows have stabilized over the past week, following what he called powerful actions from the Fed to backstop the system. That article didn't give numbers for mid-sized banks, but it appears likely that they experience large outflows as well. J.P. Morgan Chase & Co. analysts estimate that the most vulnerable U.S. banks are likely to have lost a total of about $1 trillion in deposits since last year, with half of the outflows occurring in March following the collapse of Silicon Valley Bank. The uncertainty generated by deposit movements could cause banks to become more cautious on lending, they wrote. Regulators closed SVB and Signature Bank earlier this month, marking the second and third largest failures in U.S. banking history, respectively. The speed at which customers withdrew their money from the two banks sparked concern of bank runs spreading to other institutions, prompting U.S. authorities to backstop their deposits. The failures amplified worries among customers who rushed to move their money to bigger banks that were perceived to be safer and hold a greater share of insured deposits. Of the $17 trillion of total U.S. bank deposits, nearly $7 trillion are not insured by the Federal Deposit Insurance Corps, FDIC, the JP Morgan analyst wrote. This really is a banking meltdown, and it has been going on for quite some time. And as Bill Ackman has aptly noted, if something is not done, our small and mid-sized banks are headed for disaster. Consider recent events impacting on the long-term cost of equity capital for non-systemically important banks, where you can wake up one day as a shareholder or bondholder and your investment instantly goes to zero. When combined with the higher cost of debt and deposits due to rising rates, consider what the impact will be on lending rates in our economy. The longer this banking crisis is allowed to continue, the greater the damage to smaller banks and their ability to access low-cost capital. Trust and confidence are earned over many years, but can be wiped out in a few days. I fear we are heading for another train wreck. Hopefully, our regulators will get this right. There are more than 4,000 banks in the United States right now, and the vast majority of them are rapidly losing deposits. As a result, U.S. banks are being forced to turn to the Fed for help at a very frightening rate. Banks have been flocking to emergency lending facilities set up after the failures of SVB and Signature. Data released Thursday showed that institutions took a daily average of $116.1 billion worth of loans from the central bank's discount window, the highest since the financial crisis, and have taken out $53.7 billion from the Bank Term Funding Program. Meanwhile, the banking crisis in Europe has taken another very alarming turn. On Friday, shares of Deutsche Bank plunged due to renewed concern about the stability of Germany's biggest bank. Deutsche Bank shares fell on Friday following a spike in credit default swaps Thursday night, as concerns about the stability of European banks persisted. The Frankfurt-listed stock was down 14% at one point during the session, but trimmed losses to close 8.6% lower on Friday afternoon. The German lender's Frankfurt-listed shares retreated for a third consecutive day and have now lost more than a fifth of their value so far this month. The emergency rescue of Credit Suisse by UBS in the wake of the collapse of U.S.-based Silicon Valley Bank has triggered contagion concern among investors, which was deepened by further monetary policy tightening from the U.S. Federal Reserve on Wednesday. Deutsche Bank led broad declines for major European banking stocks on Friday, with German rival Commerzbank shedding 9%, while Credit Suisse, Societe Generale, and UBS each fell by more than 7%. Barclays and BNP Paribas both dropped by more than 6%. In an uncertain economic environment, and with investor confidence remaining fragile, there is a risk that policymakers will be unable to curtail the current turmoil without longer-lasting and potentially severe repercussions within and beyond the banking sector, the ratings agency Credit Strategy team said. Even before bank stress became evident, we had expected global credit conditions to continue to weaken in 2023 as a result of significantly higher interest rates and lower growth, including recessions in some countries. It'll be interesting to see if Credit Suisse or Deutsche Bank ends up going under first. Of course, the politicians continue to tell us that everything is just fine. In fact, German Chancellor Olaf Scholz is insisting that there is no reason to be concerned. It's a very profitable bank, he told reporters in Brussels, where EU leaders issued a joint statement describing the European banking system as resilient, with strong capital and liquidity positions. Deutsche Bank declined to comment. Once upon a time, we were told that Lehman Brothers would be just fine. And earlier this month, we were told that Silicon Valley Bank would be just fine. But it isn't just a few isolated banks that are in trouble these days. Right now, the entire system is coming apart at the seams. and Steve Quayle is warning that things will really kick into high gear in April. The word collapse is a great word, and the other word that comes with collapse is calamity. With the collapse and calamity underway, people think, well, as long as it doesn't touch me, I'll be okay, or I'll be dead, my kids will have to deal with it. What a selfish way to deal with the biblical times we live in. I think we are in big trouble with this banking situation that will really kick into high gear in April. You may not have much sympathy for the banks, and I understand that. But what's going to happen to our economy when the flow of mortgages, auto loans, and credit cards is greatly restricted? Our country is already being torn to shreds like a $20 suit, and economic conditions are still relatively stable. So, what's going to happen when we do fall into a very deep economic depression? These are such perilous times, and they're only going to get more difficult in the months ahead. What are your views? Let us know in the comments, and thank you for watching.